Welcome to IG's Trading the Markets podcast. I'm Jeremy Naylor. We have what could be a human tragedy unfolding in front of our eyes, and we don't know yet just how deep and how wide the coronavirus is going to impact us all. But away from the human tragedy and the human element of this, the coronavirus has also started to make itself felt on global business, as British Airways has announced it's suspending flights to and from mainland China. But is there any area that is likely to see more of an impact? Or can we find some areas of insulation? Let's talk now to Martin Essex, analyst at Daily FX. Martin, it's good to talk to you. With recent highs, and in some cases record highs that we've seen on Wall Street for the Dow, the S&P 500, the Nasdaq, it's clear that people seem to be happy having a reason to sell some of these extended positions. But from your view, where is the likely impact going to be?
Hello, Jeremy. Yes, good to talk to you. For me, the most important impact of this, apart from the human impact, will be on market sentiment, because I think this has really woken people up to the idea that there could be setbacks to the market when prices are as high as they are. So sentiment has taken a knock, and what that's done is it has knocked stock markets lower. Currencies that people go into when they're feeling optimistic, like the Australian dollar, have fallen. And on the other side of the coin, money has gone into bonds in particular, and also into gold and into the currencies that people, the so-called safe havens, like the US dollar, the Japanese yen, and the Swiss franc. And that is likely to continue, I think, that flow of money until we really know what the economic impact is going to be of this virus, the coronavirus.
Well, that's the interesting point, I think, about this, isn't it? The economic impact. As you say, we are probably a long way away from knowing precisely where this is going to make itself felt. But I was interested, actually, to notice one of the headlines pass across our terminals this week. Barclays says this week that they're now pricing in a $2 cut in the price of oil. Now, we can all make connections between what's happening and the price of oil, but it seems to me that this is quite specific, and I think for me as well, that sort of call is very early on, and if it does become more of a problem, the coronavirus actually could see far more than just $2 taken off the price of oil. What's your view on the oil and gas sector specifically with regard to what's happening?
Apart from overall sentiment, well, actually, let's go back to overall sentiment for just one moment. I think that with the markets at these levels, people are looking for an excuse to sell, and there is perhaps some profit taking in stocks, for example. We're not sure yet whether there's going to be a sustained drop or whether this is just a little bit of profit taking and then the markets will take off again. That said, you can look at a whole variety of different industries and see what the impact is likely to be on them. So if you take crude oil, that's clearly important for the global economy. And if things do begin to get bad, economically speaking, then there will be a reduction in the oil price simply because demand is going to tail off. You're also likely to see falls in tourism stocks and airlines. You could also see perhaps some gains for, let's say, pharmaceutical stocks, because you might expect the pharma industry to benefit if people are looking around for some way of combating this virus. And within stocks more generally, you could see perhaps consumer discretionary stocks. So let's say the people who make smart clothes, you could see those falling and money perhaps going into consumer staples like food, because those are the things that people have to buy, whatever's going on elsewhere.
Just picking up on the first of that list of sectors to watch out for, and talking specifically about tourism. And as I said, with this news that British Airways has decided to make this call to stop flights to and from mainland China, at the moment we know that, or we believe and we understand from the scientists that the root of this, the center of this, is in China. At what point does all of a sudden the world stop moving around? We hear some potentially dreadful projections about what could happen, but clearly at the moment people are just acting in possibly what they see as the best interests. What goes first of all? I mean, we can't stop taking food around the planet, presumably, because we all rely on food, as you said, as a basic staple. So we'd need to have a continued supply of that. Is it just people movement, or are we then likely to see ultimately food stopping being moved around the planet?
Well, the two previous events that you should compare this to perhaps are the SARS outbreak in China in 2002 and 2003. And then the main impact was there were, I think, nearly 800 deaths then. And the swine flu outbreak in 2009-10 that started in Mexico, and that, I believe, caused far more deaths. If it were to be of that sort of scale, and we don't know that yet, then there could be a much broader impact. I think that food will probably still travel around the world, but as you say, there's going to be a problem, isn't there, with the food having to be inspected when it arrives to make sure that it's not somehow contaminated. I guess that would be meat in particular, but other things too. So eventually, if this does become as bad as those two outbreaks, SARS and swine flu, yes, there could be a major impact, but it is much too early to say. I know people always say that, but really we can't tell how widespread this is. What we do know is that it seems to be spreading around the world, and that's a very dangerous sign, not just for people, but for the free flow of goods.
And of course, that ultimately then obviously has a really, really major impact on the global economy. In terms of the global economy, we know from recent evidence that Europe is slowing. The US is finding it difficult to get any really serious upward momentum in their GDP, although GDP there is slightly better than it is in Europe and the UK. We also know from recent evidence that was provided to us by China that Chinese growth remains at 6% on what we're told. Do you see major downside potential for GDP? I guess going back to what you were saying about the impacts of the SARS virus at the beginning of the 21st century, and also the Mexican swine flu, is evidence to suggest that the growth will start to stall. I mean, China's growth is looking very precarious, isn't it?
Well, clearly the impact is likely to be felt on China first, and although Chinese growth is slowing, it is still, as you say, around 6%, which is much higher than in the more developed countries. So in a sense, perhaps China could take the shock better than we can in the West. But also, as you say, growth is very anemic pretty much everywhere where you look, whether it's the UK or it's Europe or it's America. Growth is slow, and that's why interest rates are so low. That's why quantitative easing has been introduced pretty much everywhere. And you have to worry that the central banks no longer have the ammunition to inject more money into the economy. I mean, the central bankers are warning that it's now up to governments to ease fiscal policy, but that takes a long time to come into effect. So if the central banks decided that to try and bolster growth, they needed to inject more money into their economies, they've got almost no room for maneuver with interest rates as low as they are and growth so weak pretty much everywhere you look in the West.
You mentioned about the Australian dollar earlier on the podcast. It seems to me that because there is this strong relationship between Australia and what's happening in China. I mean, Australia provides a lot of the commodities, of course, so its currency is partly dependent on the demand from China. With this drop in the Australian dollar, to what degree do you see that as like the canary in the coal mine for what's happening in China? And do you think that itself is an indication that we should be wary of?
Oh, yes, Jeremy. As you say, the Australian dollar is seen in the financial markets as a proxy for China. It's a widely traded currency, and it's a proxy because Australia has such close economic ties with China. So if you look at that particular currency pair, at the start of this year it was around 0.70. That's the Australian dollar worth 0.70 US dollars. That was at the start of the year. It's now down to about let's say 0.6750, that sort of level. That's a huge fall that we've seen already. Now, you might expect there to be some sort of bounce from that, but there's very little sign of that yet. And so that's money coming out of the Australian dollar, which is the canary in the coal mine and into the safest of assets, which is essentially the US Treasury market. So if you look at the yield on the 10-year US Treasury, that's dropped from 1.9% at the start of the year to 1.6% roughly now. So what we're seeing is money going into bonds, lifting the price, and that of course lowers the yield. This is what is really happening at the moment. People are looking at all these safe havens, which I listed before. They're looking at the so-called risk-on currencies, not just the Australian dollar, but also, let's say, the New Zealand dollar, the Canadian dollar, and they're opting in the currency markets for the safety of the ones like the US dollar that are safer. So yes, I think that there's a big impact at the moment, and the Australian dollar is the one that's really telling us more than anything to be careful.
Yes, it's interesting. I'm looking at, for example, the US dollar trade at the moment, the basket trade, 97.75. We've got levels that we've not seen in several months or so in terms of the height of the US dollar. So obviously that is benefiting. When we talk about the dollar rising, we quite often talk about the opposite effect on the price of gold. You mentioned at the top that gold is rising. It's interesting, actually. I guess this is probably another warning sign, I suppose, really. Do you regard that as something that's going to continue, this rise in the dollar at the same time as a rise in the price of gold?
Interesting, isn't it? Because gold has, in a sense, not really benefited to the extent that you might have expected to. Gold is the traditional bolt hole, but it's really hardly moved this year. The price I'm looking at now is somewhere between $1,550 and $1,600 an ounce. It has been heading higher over the last couple of weeks, but not substantially. People seem to be slightly worried about gold, and so it's in a sense not fulfilling its usual role as a haven. So compare that broadly flat trend with what you were saying about the way the dollar basket is moving. Now that was around 96 at the start of the year. It's now getting on for 98. So there's been a very big increase in the price of the dollar, but not much increase in the price of gold. And that could be simply because people prefer perhaps bonds. I mean, perhaps people are switching from stocks to bonds, which is one of the key things that market players do when this sort of worry creeps around.
One of the largest component parts, of course, of the dollar basket is the euro-dollar trade. I think it's about 60 or 70%. So we should expect clearly some representation in what we've just been talking about in the dollar basket in the euro-dollar. But I'm keen, though, to look at the euro-dollar from the euro side of things. When we get this sort of event unfolding in front of our eyes at the moment, and of course we all hope that there's going to be some stop put on it very soon by the authorities, and let's hope there's some sort of way in which the science community can help out. But if things do continue the way they are, what happens to the euro in this? Is it just a symptom of the strong dollar, or is there a euro trade to undertake on the basis that this is now possibly a global event?
I don't see specific euro factors in this. The euro's gone down from around 112 at the start of the year to around 110 now against the dollar. So that also has fallen very steeply. The euro is also now seen as a risk-on currency rather than a risk-off one. And so that's been falling very steeply. But I don't see that specifically as the euro side of the equation, because we've just had a European Central Bank meeting at which all their monetary levers were left untouched. And there's really no chance short term of Eurozone monetary policy being changed. Indeed, the new ECB chief, Christine Lagarde, has said that she wants to spend, I think it's around a year probably, monitoring how they do things at the ECB, and that could lead to changes. We're not really expecting any move in interest rates or other monetary policy moves from the ECB. So I think it's going to simply move with the general worldwide trend. It'll be affected, of course, by the dollar, but it'll also be affected much more broadly by sentiment.
Yeah, look, Martin, we'll have to leave it there, but thank you so much indeed for joining us. There's so much we don't yet know. I guess it's a question of just waiting for the next news headline. But Martin, look, it's good to talk to you. Thanks for joining us.
My pleasure.
That's Martin Essex from Daily FX, taking a look at the impact on the business and the economy of the coronavirus.